Well, good afternoon and welcome to HiRock's weekly webinar where we will be talking about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm happy to be back in the driver's seat. I'm joined by my partner and colleague, Paul Tepsich, the founder of HiRock, who, by the way, has done some great bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year, continuing to add value to our portfolios while at the same time reducing our exposure to risk. Our financial planner and wealth forecast specialist, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you are a first-time listener and would like a little bit more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. All right, as we do each week, let's recap our themes for 2016 before we get started on what has happened since we last talked. Well, as you all well know by now, our overriding theme for 2016 is that financial markets will remain volatile. January and early February saw a spike in volatility, but markets did settle thanks to continued central bank monetary stimulus. Volatility bounced back in the uncertainty that was post-Brexit, and although it has calmed again, uncertainty has far from gone away. The U.S. economy represents 20% of the global economy, and over 50% of the companies in our benchmark equity index are domiciled in the U.S. So we spend a great deal of our efforts trying to determine how the U.S. economy will evolve. The U.S. economy barely scraped by in the first half of 2016 with an annualized growth rate of about 1%. Things are looking a little better at the moment for the third quarter, but that is how the second quarter started before it fizzled. And there are some telltale signs emerging that suggest a recession may not be far away. Low inflation and deflationary pressures continue on a global scale despite the efforts of central banks to mitigate them. Stimulative central bank monetary policy on its own has not succeeded in reigniting economic growth. Geopolitical uncertainty has become a major factor. Brexit and the rise of populism in developed nations, the United States presidential race, terrorism, instability in some countries are all having an impact on the consumer, business, and investor psychology. There has been a flight of capital into safe government bonds, driving prices higher and yields to record lows, negative yields, and flatter yield curves, which foretell of more and potential economic pain. Equity market prices have been comforted by central bank monetary policy stimulus to combat the potential for additional volatility, and share buybacks have artificially driven prices higher. At current levels, they are as expensive in terms of earnings and valuations as they have ever been, and our comfort level with this asset class remains extremely low. There's no clear economic direction. Businesses will tend to postpone investment decisions. Consumers will postpone spending decisions until they can get a better sense of what to expect in the future. We are in a time when the risk-free rate of return is dangerously close to 0%, which means that to get the higher returns that they want, investors are taking on more risk, likely more than what we think would be wise. So we think this makes for a precarious situation for investing, and that caution should be the order of the day. Nothing new on that front, though, for us. We continue to monitor all of these things. Okay, what's been driving markets over the last week? After spikes in January and February, and again in June, volatility hit its lowest levels in August. There is still 4 months left in the year, and the September-October period is traditionally the most volatile time of the year. So we'll watch closely to see what may transpire over that period. Historically, when it gets to these low levels, the next move tends to be higher, and that is probably no different for this period of what we would expect to be higher levels of volatility. The Fear and Greed Index moved to nosebleed territory up into the 90s before slipping back to where it is currently. We think that cause and effect is consistent, and in this particular case, we don't think there's going to be any difference. So we think that we're going to see a move to more fearful situations as we go forward. Since our last webinar, our benchmark equity index is higher by 1.34%, and it's better by about 6.75% on the year. Japan's Nikkei 225 index was the best performer over the week, while Australia's All Ordinaries index was the worst performer again. The Canadian TSX has been the best performing country index in the developed world this year. China's Shanghai Composite Index has been a very poor performer. The broad and diversified benchmark equity index upon which we gauge the performance of our model and portfolio performance covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries, and covers 10 economic sectors. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. Over the last month, there has been little follow-through buying after our benchmark all-country world index broke above its downtrend channel, which began back in May of 2015. The trading volume has remained quite light relative to what we saw at the beginning of the year. To date, 2016, the all-country world index has posted a return of about 7.5%. The one-year return has jumped to about 12.5% because of last August meltdown, but it does show how buying those down days, as we saw last August, can actually be rewarding if you are patient. We see a 6.6% return for 3 years and about 9.8% over the last 5 years. Well, if you combine the equity and bond indices into a balanced scenario and allow for fees and MER costs, the total return for a 60% equity, 40% bond index combination year to date is about 5.5%, about 8.3% over the course of the last year. And of course, that's up, as I said, because that big jump in the from last August lows. 3-year return has been about 5.25%. 6.3 for the 5-year return. For a less risky 40% equity, 60% fixed income portfolio, the benchmark return after fees year to date about just a little under 5%. 1 year about 6, a little over 6.75, a little over 5% for 3 years, and a little over 5% as well for 5 years. Now, by comparison, a client who started with us in January has a total return this year to date after fees and costs of about 6.3%, nicely ahead of that benchmark number at 5.5%. The after fees and costs of a 1-year performance for a 60/40 HIROC client is a little behind the 8.3% return of the benchmark, which we don't even see on there for some reason. There it is, 6.88. And then the 3-year performance is well ahead of the 5.24 return for that same period of time on the benchmark. Now, I must also remind all of our listeners that, and I'm sure that you're very well aware of all of this, but historical returns are in no way a guarantee of future returns. Although at HIROC, we work very hard to try to get the very best possible risk-adjusted returns for our clients and for ourselves at all times. The Canadian Preferred Share Index dropped again this week. As we have been suggesting, there is new supply being added and potentially more supply to come in the Canadian fixed reset preferred share market. It has certainly been the worst performing of the fixed income assets this year. As we've discussed from time to time, both on our blogs and in our webinars, that sometimes there are perception issues at the investment advisor level as to what asset classes are deemed to be safer or have less risk and volatility. Now, as the manager of the Advantage Canadian High Yield Bond Fund in our institutional business, we saw a fair bit of selling last year of the Advantage Canadian High Yield Bond Fund, AHY.UN, but it turns out to have been a better buy for the buyers on the other side of that trade, as the total return over the last year was over 4%, while the preferred share index ETF, CPD, had a negative return. Over the course of last week, gold was higher, oil and natural gas were lower. Oil had bounced off the $40 area a few weeks ago, but has struggled to get back to that $50 level. We're watching developments there with regards to OPEC and Russia's influence, and we'll keep an eye on developments as they come. The Bloomberg Commodity Index, though, has broken down through the bottom of its recent uptrend channel, so we'll keep an eye on how things develop there as well. With over 50% of the companies in our benchmark index domiciled in the U.S., we keep a close eye on what is happening in the U.S. economy. Almost 70% of the U.S. economy dependent on the consumer. It is important for the consumer to be confident. When consumers are uncertain, they tend to postpone spending, as I said before, and when businesses are uncertain, they postpone investing. This makes it a tough environment for economic growth, which in turn makes it difficult for corporate earnings to grow. The latest presidential election polls have narrowed the gap since last week. This represents an enormous amount of uncertainty, as it could considerably shift the balance in the world political situation and certainly the North American political situation. The Institute for Supply Management's Purchasing Managers Index came in at 49.4 in August, down from 52.6 in July. The figure came in much worse than market expectations, which were around the 52 level, and it's reached its lowest level in 7 months as new orders, production, and employment all contracted. That 50 line is below which is where it's expected the economy could contract as a result of lower purchasing decisions by supply managers. And as Paul mentioned in his blog this morning, data also from the services sector suggests more weakness. The services sector has been the glue for the U.S. economy, and it appears to be growing at a markedly slower pace after the most recent data is remarkably close to contracting like the manufacturing sector is. So again, something for us to keep our eye on, but certainly not boding well for economic data. Now, the contribution of net exports to third quarter real GDP growth increased following Friday's international trade release from the U.S. Census Bureau. So third quarter GDP is still expected at the moment to show a growth rate of approximately 3.5%. That'll be unchanged from the number that we showed last week. Well, the much anticipated U.S. employment data report did not add much certainty to the debate over whether the U.S. Federal Reserve will raise interest rates next at their next meeting, which will happen on September the 21st. The Fed announced their desire to normalize rates a couple of years ago. However, economic conditions continue to hold them back. They continue to claim that they are dependent on key economic data that to date have not been inspiring, although they continue to remain, for the general public, vocally optimistic about the future. Their lack of action tells us something different, basically that they cannot follow through on their optimism because they see data that also concern them. We continue to believe, and behind the scenes we expect that the Fed must also realize that by raising short-term interest rates, they will flatten the yield curve and push the U.S. economy closer to recession. That would be what we would call a catch-22 situation for them. Well, on our recession watch radar screen, and something which I noted on my blog on Friday, the 3-year moving average unemployment rate is now converging on the current unemployment rate at a faster pace. Now, at this pace, in a few more months, they will intersect. Historically, when they intersect, a recession tends to follow. Interesting how that ties in with the approximate timing of the U.S. presidential election. And meanwhile, elsewhere in the global economy, well, Brexit has slipped from the front pages of the financial press, which is typical because it is no longer the shiny object that is catching everyone's attention. However, it will take years before the ultimate impact is to be seen, so we shall have to continue to pay attention to the ongoing developments. A petition by about 4 million people in the UK to hold a second referendum was debated in British Parliament yesterday. However, Prime Minister Theresa May, who did not support leaving, says Brexit means Brexit and the vote will be respected. At least 7 lawsuits have been brought to force the government to accept that Parliament should decide whether Britain should trigger Article 50 of the Lisbon Treaty, the formal exit process, rather than the Prime Minister. Over a month ago, the Bank of England launched a huge new stimulus package in order to mitigate the damage the Brexit vote would have on the UK economy. The package included a 25 basis point cut in the bank rate to 0.25%. Since then, the pound has stabilized and, in fact, rallied somewhat over the last week, back close to the best level since the referendum results were announced. Equity markets in the UK have also improved. UK companies make up about 6.5% of our benchmark all-country world index. The Bank of England will announce its latest interest rate decisions on September the 15th. While euro area core inflation has remained well below the European Central Bank's 2% target for some time now, despite aggressive and extraordinary monetary policy that has included negative short-term interest rates. It is clear that, at least to date, monetary policy alone has been unable to restart economic growth to lift inflation. ECB meets on Thursday to announce their next steps. Well, euro area stocks have struggled this year. In Japan, core inflation has declined below the 0% level. Now, that's indicative of deflation. Bank of Japan monetary policy and government fiscal measures have yet to stem this problem. And not unlike European equity markets, Japanese equity markets have struggled this year. Negative interest rates have definitely not inspired domestic stock markets in their respective countries. Canada, which represents a little more than 3% of the all-country world index benchmark, has been the best performer this year, as I mentioned before, after being the worst performer last year. So Canada's obviously been doing reasonably well. We wonder if that will hold. Shanghai's composite index, about 2% of the all-country world index benchmark, had some spectacular moves in 2015, but has been actually the worst performer in 2016 to date. Well, where do we see all this taking us? Let's check in with the bond markets because they do tend to lead other financial markets. But at the moment, despite the employment data, there's not much change in the current U.S. yield curve over the last week. And not much change to the curve in the UK either. The German curve is mildly steeper, but still negative yields show out to 13 or 14 years. And the Japanese yield curve is a little steeper, but still with yields negative out to approximately 10 years. And very little change in Canada. So not much going on in the bond markets from the curves. We see generally the curves have been flattening. However, they haven't moved a whole lot over the course of the last week. As for equity markets, well, as we say each week, why are earnings important? Well, when investors buy stocks, they do buy a stream of future earnings, which go to pay dividends or are normally reinvested in the company. The price to earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price-earnings ratio is 14.3 times. The 12-month forward price-earnings ratio is currently at an expensive approximately 17 times. We think that difference is making stocks very expensive at the moment. Well, this year alone, earnings for the year have been revised from an expected rate of growth of 6% at the beginning of the year to a negative 0.4% at this particular time. Now, while the S&P 500 stock prices have risen so far this year by about 7%. Third quarter earnings are expected to continue with negative growth for a sixth consecutive quarter. So why are stock prices so high? Well, because investors are taking on greater risk as they chase higher potential returns, opting for better yields from dividends than from safer assets. However, even a little increase in volatility could erase any extra returns that they might get from dividends. And personally, Paul and I prefer to remain more prudent with our investment decisions. What does it all mean? Well, for well over a year, we continue to repeat our mantra. We take a cautious and defensive posture to investing, and it has been a fortuitous situation for our clients and also for ourselves, because remember that we are investing in the exact same models and securities as you do. We monitor a great many metrics that help us to determine where there might be some value, but until we're convinced that there is value, we will remain patient. With increased levels of uncertainty arising from the Brexit referendum, we are in no hurry to take added risk unless we see reasonable opportunity. Others may be willing to take on greater risk, but we are not. And as I say, each week, cash and cash equivalents have been and continue to be important defensive assets for us, so we will be carrying greater than normal cash balances in our models. If we can attain better than benchmark returns, having more cash and less exposure to risk, we are taking smarter risk. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, your goals, your risk tolerance, and time horizons. However, the ongoing research and analysis that we do at HIROC will dictate the minor adjustments in short-term strategy that we make in our models, which we believe add value to the long-term performance. Speaking of performance, and to answer a question that I get on a regular basis now, if we are so cautious, are we not missing out on the rally as equity markets hit new highs? Well, the answer to that, in a nutshell, is no. Our models are not missing out. We are taking less risk and still getting better than benchmark returns, which means significantly better risk-adjusted returns for our and our clients' portfolios. Better than those who are fully invested and are exposed to greater amounts of risk. That is how we add value. If, as we suspect, stock markets correct, our models and portfolios will give back significantly less and keep more than the higher risk buy and hold strategies. Paul, anything to add with regards to our tactical model at the moment?
Sure, thanks, Scott. I think I mentioned this the same last week, but we did a little bit of trading over the past month where we took some profits in some energy stocks and bought certainly one of them back, probably picked up about 10%. So we haven't done a lot of trading. I'm still doing some work on, actually I opened up a new file last week. It's going to be very complicated, so it's going to take me quite a while to get through. And I'm not even sure we're going to buy this stock, or there's a convertible bond outstanding on this issuer. But that's taking some time to get through, and we won't buy it until we get the work done. Other than that, we haven't done a lot of trading in the tactical portfolio, save for the couple energy trades. But I'm still reasonably bullish on energy and some commodities in general. I think if Scott and I are right here, and certainly today may prove correct, but the Fed may indeed not raise rates, and that will prompt the US dollar to go lower, and that prompts any assets priced in US dollars to go higher, and mostly embedded in the commodity space. So we have bets across various parts of the capital structure in energy, both through some high yield debt, some convertible bonds, and some equities. That's it.
Thanks, Paul. And when you say bets, just to reassure all our clients, we're not really gamblers here. We take what we call very, very informed positions, right?
Yeah, sorry, that's old trader speak from decades ago. But yeah, these are positions and investments, but they are tactical in nature. As an example, we are core long one energy stock, and I sold out half of it, and I bought more than half of it back at a 10% discount. So that's being tactical, but these are well-researched investment positions that we put on.
Thanks. Appreciate that, the clarification. Okay, so what are we looking for coming down the pipe as far as data and information that the market will present or the market will be watching? Tomorrow we're going to get the latest from the Bank of Canada. We're also going to get some information on the latest trade with China, which is always important to get a sense of how that economy is moving. And then on Thursday, we're going to see the latest interest rate decision from the European Central Bank, as well as some inflation data from China. On Friday, some trade data from Great Britain. Of course, not likely to be impacted significantly yet by Brexit. That will likely take time, but still we have to keep an eye on it. Canadian employment data will come out on Friday. Next Tuesday, we'll see some inflation data from the UK and some important economic sentiment from Germany. And then, of course, we'll have our HIROC webinar on Tuesday as well. And again, as I mentioned, we'll see the Bank of England's interest rate decision next Thursday. And something I did forget to mention, tomorrow, for those who don't have anything better to do, I'm going to be on BNN at about 3:45. So feel free to tune in. Likely won't be telling you anything that you haven't heard me say before on these webinars, but you can look at my pretty face. And an announcement for all our clients and our clients who wish and would be interested in introducing us to any of their friends. We're going to have a little get-together on Wednesday, October the 5th. You will get a formal invitation, of course. That will happen downtown Toronto, Midtown Toronto, about 7 to 9. We're going to have very special guests. Canadian author Tim Faulkner, who's just written a book called Bad Singer, and I think you'll find him very, very entertaining as well. With Tim will be Tyler Ellis, a Toronto musician and music teacher. They recently did a sold-out presentation in Halifax, and I'm sure it's going to be a great evening. Get together. Looking forward to seeing some of our clients and meeting a few of their friends, and also a few of our friends too. All right, I have gone over the time allotment today, so we're just going to forego the question period. But if you do have questions, please feel free to send them to me, email them, and we'll definitely get on them for our next call. And of course, if you're listening to the recorded version, if you have questions, don't forget to email them to us as well. We certainly appreciate all the feedback that we get. But as always, thank you for taking the time out of your busy schedule to tune in. Don't forget to join us again next week. But until then, this is Scott Tomlinson signing off.